Hello and welcome back to our channel. In today's video, we will be discussing the best option strategies to use in 2023 for generating passive income. Whether you're a beginner or an experienced investor, these strategies can help you generate steady returns while minimizing risks. So let's get started. Covered call strategy. The covered call strategy involves selling call options against stocks you already own. This allows you to generate income from the premiums received while still holding on to the underlying stocks. For example, if you own 100 shares of Apple at $150 per share, you could sell a call option with a strike price of $160 and receive a premium of $3 per share. If Apple's stock price stays below $160, you keep the premium and can continue to sell more call options. If the stock price rises above $160, the buyer of the call option can exercise their right to buy the stock from you at $160, and you would have to sell your shares at that price. However, you would still make a profit from the premium received, and you can always buy back the shares if you want to hold on to them. Cash-secured put strategy. The cash-secured put strategy involves selling put options against stocks you want to buy. This allows you to generate income from the premiums received while potentially buying stocks at a discount. For example, if you want to buy 100 shares of Microsoft at $200 per share, you could sell a put option with a strike price of $190 and receive a premium of $2 per share. If Microsoft's stock price stays above $190, you keep the premium and can continue to sell more put options. If the stock price falls below $190, the buyer of the put option can exercise their right to sell the stock to you at $190, and you would have to buy the shares at that price. However, you would still make a profit from the premium received, and you can hold on to the shares or sell them for a profit if the stock price rebounds. Iron Condor strategy. The Iron Condor strategy involves selling both call and put options with different strike prices to create a range in which the stock price can move while still generating income from the premiums received. For example, if you believe that Amazon's stock price will remain between $3,000 and $3,200 over the next few months, you could sell a call option with a strike price of $3,200 and a put option with a strike price of $3,000. You would receive a premium for both options, and as long as Amazon's stock price stays within that range, you keep the premiums and can continue to sell more options. If the stock price rises above $3,200 or falls below $3,000, you could potentially lose money, but the maximum loss is limited because you also bought call and put options at higher and lower strike prices to limit your risk. Long straddle. The long straddle strategy involves buying both call and put options on the same underlying asset with the same strike price and expiration date. This strategy is best suited for investors who expect the underlying asset to experience significant price movements. It allows investors to profit regardless of which direction the price moves, as long as the movement is significant. For example, let's say an investor buys a call option and a put option on a stock with a strike price of $50 and an expiration date of March 2023. The investor pays a premium for both options. If the stock price increases to $60, the investor can exercise the call option and earn a profit. If the stock price decreases to $40, the investor can exercise the put option and earn a profit. The key is that the price movement must be significant enough to cover the premium paid for both options. Credit spreads. Credit spreads involve selling a call or put option and simultaneously buying a further out-of-the-money call or put option. This strategy is best suited for investors who want to generate income while limiting their risks. By selling a call or put option, the investor collects a premium, which serves as their income. By simultaneously buying a further out-of-the-money call or put option, the investor limits their potential losses. For example, let's say an investor sells a call option with a strike price of $50 and buys a call option with a strike price of $60. The investor collects a premium from the call option they sold, which serves as their income. If the price of the underlying asset stays below $50 at expiration, both options will expire worthless, and the investor keeps the premium. However, if the price goes beyond $60, the investor's potential losses are limited, as they can exercise the call option they bought to cover the losses. As a summary, The covered call strategy allows you to generate income from the premiums received while still holding on to the underlying stocks. Cash covered put strategy, on the other hand, allows you to generate income from the premiums received while potentially buying stocks at a discount. The Iron Condor strategy is suitable for conservative investors looking to generate income while minimizing risks. The long straddle strategy is suitable for investors who expect significant price movements in the underlying asset. Finally, the credit spread strategy is suitable for investors who want to generate income while limiting their risks. That's all for today's video on the best option strategies to use in 2023 for generating passive income. We hope you found these strategies helpful and informative. As always, please remember to do your own research before making any investment decisions. Don't forget to like and subscribe to our channel for more investment tips and strategies. Thank you for watching, and we'll see you in the next video.